Hey, what's going on, YouTube, and welcome back to Tech Conversations. As always, I'm your host, Guillermo, and as always, I'm not a financial expert nor licensed professional. If you plan on investing in the stock market, please consult with one first and invest at your own risk. So, firstly, smash that like button and let me know in the comment section below if the Robinhood outage that occurred earlier today affected your trades. I was actually about to exit an options trade when Robinhood just pretty much crashed. And it cost me some money, and I know it cost a lot of people on my Discord money. So let me know if anything happened to you guys in the comments section below. Hopefully, Robinhood can fix things like this from happening in the future. But anyways, today I want to talk about debit spreads, and more specifically, I want to talk about put debit spreads, or what you might hear as bear put spread. And so we're going to be using American Airlines for this demo again, okay? And I've been using American Airlines now for my credit spread videos as well, so I figured I'd continue. By the way, if you haven't checked out those credit spread videos, I'll put links to both of those in the description below. Go ahead and check them out. So let's go to Trade American Airline Options and just kind of recap what we're doing here. So as the name implies, right, a put debit spread, it's going to involve puts, and more specifically, it's going to involve buying a put and selling a put. Okay, now in contrast to credit put spreads, where the strike price of the put that you sell is higher than the strike price of the put that you buy, in this scenario, it's going to be the opposite. So the strike price of the put we're buying will be higher than the strike price of the put we're selling, right? And just to make sure that we're all on the same page, when you buy a put, you're hoping that the price of the stock goes down. That's how you're going to make money. When you sell a put, you're hoping that the price of the stock goes up, okay, or above, or stays above the strike price at least, right? And so, as you can see, when you're doing those two things, they're the complete opposite things of each other. And again, this is going to help minimize the amount that you can lose. But similarly, as with credit spreads, this is also going to minimize the amount that you could potentially make if you were to just buy a put, and we're going to see that, okay? So, again, for this demo, we're going to be using the options profit calculator. Again, it is very helpful. I'll put a link to it in the description below, but it really helps you visualize what's happening, how much money you're losing, how much money you're making, depending on the strike price of the stock and depending on the date. Okay, and so before we begin, let's actually just start by doing a simple put. Okay, let's buy a put and just analyze it for a quick minute, just so we're both on the same page. So again, we're going to use American Airlines. So you just put the symbol of the stock you're using. You click on Get Price. It shows you the price. And then you go over here. And again, we're going to buy a put. So you click on Select Option. Okay. And again, on the top here, you're going to see the expiration dates. We'll use June 26th for this demo. Okay. So we're going to buy a put that expires on June 26th. So we're going to puts over here. And again, when you're buying a put, you're hoping the price goes down, so you need to find something that's below 1643. So let's just use 16. So let's click on this ask of 92, okay? Which means we're gonna pay 92 cents per share. And again, there's 100 shares in one contract, so we're gonna pay $92, right? So for this contract, we're gonna pay $92, and that's actually gonna end up being how much we're losing. That's the most we can lose, okay? And it's actually calculated so we can see it visually and see what's happening here. So I'm going to go from 0.5 up to 17. Actually, let's go 18. And I'm going to click Calculate. And you're going to get a graph here, right? And so you can see that this is a bearish strategy, right? You're making money when the price goes down. If it starts to go up, you're losing money. And so we'll just focus on expiration date. But again, it's helpful to see here like when you're making money, when you're losing money, depending on the price and depending on the date. But let's stick to expiration date. So as you can see here, on the expiration date, the price of the stock is the strike price of the put you bought or higher. You're losing $92, right? Which is the most you can lose, right? It doesn't matter how much up it goes. It's going to be $92. Now, take a look at this though, and this estimated returns is very helpful. It shows you your break even. But look at the max return, guys. $1,508. That's the most you can make from buying this put, okay? And let's just quickly understand how you would make that. So let's imagine that on before expiration date that the price of American Airlines drops to $0, okay? And then you exercise this contract. So what that's going to really do in layman terms is you're going to end up buying 100 shares of American Airlines at $0 per share. And then since you bought this put at $16 a share, what that's going to end up, $16 strike price, what that's going to let you do is sell those 100 shares that you just bought at $16 per share. So you bought them for $0, and you're going to sell each one for $16. There's 100 shares, so that's 16 times 100, and so that would be $1,600, right? But remember, you did pay $92 for the contract. So if you subtract 92 from 1,600, you get 1,508, and that's how you can make 1,508, right? So in this regard, you're benefiting when the price goes more down and down and down, right? And that's what you can see, and this is why this is a bearish strategy, and that's why you buy puts if you think that the price is going to go down, right? Because the farther down it goes, the more you're making it. Okay, so hopefully you understand that. So let's take a look at a debit put spread then, and how that differs from this, right? And when you might want to do it. So all we got to do is we go to spreads here, and we're going to click on put spread. Again, we're going to put in our symbol, so American Airlines, we can get the price, 16,438. Okay, cool. And so again, we're going to buy a put where the strike price is higher than the put that we're going to eventually sell. So let's start off by using that exact same put that we just used in that previous example. So again, we're going to buy here a put. We're going to select option. And so again, we're going to go June 26 because that's what we used in our previous example. And we're going to use the $16 strike price again. So this is the same thing we just saw in the previous example. Again, we're going to pay $92. As you can see here for our spread, our net debit now is $92. So we're paying $92, right? That's what that means. Now let's think for a minute. What if you might think that $92 loss is just too much for you? Okay, that's too big of a risk for you. Maybe you can only lose 50 or 40, right? Anything more than that, you're just not okay with. Well, you can actually do it with this debit put spread. That it allows you to do that. And what you're going to do is you're going to sell a put, okay, and that's going to allow you to do that. And so you're going to see that the amount that you could potentially lose is going to go down. However, the amount that you can make is also going to go down a lot. And we're going to actually see this. So we're going to write or sell a put. So we'll go to select option. And as you can see, it already goes to June 26 because it has to be the same exact expiration date. And so remember, the strike price needs to be less than the strike price of the put we bought. So let's use 15 just so the math is simpler. So we're going to ask for 52 cents per share or $52. So let's take a look at this. When we buy this put, we're paying $92. When we sell this put, we're going to get $52 as a premium. And so the net debit, right, is $40. So we're only actually going to pay $40. So as you can see here, that's actually going to end up being the most that you can lose now, right? So before, when you were just buying this put, you could potentially lose 92. Now with this debit put spread, the most you can lose is only $40, right? And so that might make you feel better, because maybe that's the most you can, that's the most you're willing to risk losing, right, is $40. However, let's take a look at how much you could potentially win. What's the most you can make now? And it might shock you, it might not, but you'll see that it actually goes on a lot. So again, we're going to use the same graph range. So I'm going to calculate it. And now, as you can see, your max risk is 40, but look at your max return. It's only $60. And that previous example that I showed you, right, where we didn't have to sell a put, you could have made over $1,500, right? And so this is where you kind of have to weigh the risk to reward, because on the upside here, you're not risking as much, but on the downside, you're not nearly making as much as you could have, right? And so you got to kind of figure out if this is what's right for you or not. Okay, but that's how that works. And so if we actually take a look here, right, again, let's just focus on the expiration date. If it's 16 or above, it doesn't matter how much more higher it goes after 16. The most you're losing is 40. Now, if you go under 16, if it's 15.50, you're making 10. Once it reaches 15, you made 60, and that's the most you're going to make. And if you keep going down, as you can see, it doesn't matter how much farther it goes down, the most you're going to make is $60. Okay. Now, let's actually calculate what happens when it falls in between these two, right? So between a $16 and $15. So let's look at the $15.50. So again, remember, you're making $10. So let's kind of understand how that works. Well, this would expire worthless, right? And so that's good. But this would actually fall through. And so if it hits in between at $15.50, what's going to happen is you're going to buy 100 shares at that $15.50 strike, $50.50 share price. And so you're spending $15.50, right? But then you're going to turn around and sell each one for $16 or $1,600. And so $15.50 minus $1,600 is $50. But keep in mind, you're making $50 there, but you spent $40. And so 50 minus 40 is 10. And that's how you get that $10 at that 15, if it's $15.50 on expiration date. Okay, so keep that in mind. That's basically the main concept here. And again, this is a bearish strategy. You want the price to go down because that's how you're gonna make the maximum reward that you can get. And so let's go back to Robinhood and just quickly graph this out. Not graph it out, but just demo it out and show you how you would create that debit spread. So remember, we're dealing with puts. And so let's buy the put first, and we were using the June 26th expiration date. And so we were using 16. Now it looks like it's kind of gone down a little bit, but that's fine. So you're going to click on here. We're going to buy a put, and we're going to pay $86. And then we're going to sell a put. And then remember, strike price should be lower than the put that you bought. And so let's sell this $15 one. And so we're going to receive $47. And so as you can see, we're paying $86, but we're selling and getting a $47 premium. So we're only going to pay $39. As you can see, it recognizes this as a put debit spread. We're going to continue. And so you can go one share. And you can, ask for the limit price. You could try to lower it. Usually it needs to be somewhere in between for this to go through. Review order, right? And so you can see, we're going to buy it to open a put at a $16 strike price. And then we're going to sell to open a $15 or a put at a $15 strike price. And then both the expiration dates are the same. So this is what you would do to create the put debit spread. You would submit it, and then you would be set to go. Okay, so I hope that's not so confusing. I hope that sort of makes sense. Again, I really recommend you guys coming to this options profit calculator and just messing around with it. Choose your favorite stock that you think you want to trade options with. And don't even start with spreads if you're a beginner. Just do calls and puts, and just look at the graphs and just try to visually understand what's happening and how this all works before you do it. Okay, so please do your research before you do this. Please consult with a professional before you do this. If you guys have any questions for me, best way to get a hold of me is through my Discord. Link to it is in the description below. My friends and I, we post weekly watch lists. We talk about day trading, swing trading, trading options. Go ahead and join if you'd like. Also, if you plan on using Robinhood in the future, feel free to use my referral link in the description below. If you sign up using my link, you will receive one free stock, which is free money for you. So go ahead and use it if you'd like. And as always, guys, I hope you enjoyed the video. Again, let me know what you guys think. Make sure you subscribe if you enjoyed the video. And I'll see you guys next time.